Good day. Thank you for joining us. I'm Warren Davison and I'll be taking you through the October 2019 PSG Wealth Offshore Fund performance. Setting the macro scene. October saw gains from global equities amid signs of progress on the US-China trade deal, while central banks remained supportive. US equities rallied over the 2 months on positive sentiment. US-China trade negotiations saw the two sides agree the outline of a potential mini-trade deal, supporting markets. The Federal Reserve lowered their interest rates by 25 basis points, making that the third cut this year. Jerome Powell has indicated no further cuts will take place this year, and their target range is between 1.5 and 1.75%. Eurozone equities posted gains as some economically sensitive sectors performed well. GDP data for Q3 defied recession worries, with Eurozone economy expanding 0.2% quarter-on-quarter. UK equities underperformed against the backdrop of a very strong rebound in the sterling. Sterling bounced back 5.3% against the greenback, as the prospect of a no-deal Brexit outcome on 31st of October receded. With approximately 70% of the FTSE all-share revenue coming from abroad, the strengthening in the sterling caused the index to fall 1.4% over the month. The Japanese market recorded a gain of 5%. The yen fluctuated against major currencies, reflecting changing views on the likely action of central banks, but ended the month virtually unchanged against the dollar. Emerging market equities recorded a strong return, benefiting from the pickup in risk appetite. Positive sentiment towards US-China trade talks, further global central bank easing, and US dollar weakening all proved supportive. With the fixed income market, global bond yields rose overall. Corporate bonds produced positive returns and outperformed government bonds. Looking at the 5-year numbers, this points to the importance of long-term investing. Even though we have experienced heightened volatility in the shorter term, longer-term returns all remain in the green. This month's focus point is GDP growth rates. Germany and the United Kingdom both narrowly dodged a recession, with their Q3 growth rate delivering positive numbers. With global growth showing signs of a slowdown, these two economies are both under significant pressure from US-China trade talks as well as Brexit concerns. Looking at the performance of the PSG Wealth Funder funds over the minimum investment periods. The funds had a mixed month, with the USD pound class performing better than the pound counterparts. Over the minimum recommended investment period, all global funds are ahead of their respective benchmark, with the exception of the preserver pound class. October saw mixed results, with the funds featuring in the first, second, and fourth quartile. Long-term relative rankings remained excellent, with top quartile performance from 4 of our 6 funder funds since inception. Looking closer at the rankings, 4 of the 6 funds are actually ranked in the top 10 funds within their category. Some highlights for the month. Growth stocks outperformed value, with the MSCI World Growth and MSCI World Value net return returning 3 and 2.06% respectively. Stocks in the healthcare, information technology, and communication services sector gained most over the month, while energy, utilities, and consumer staples saw weaker growth. The PSG selected managers held up well, with 22 of the underlying managers outperforming their peer group. Looking at our quantitative risk radar, 2 funds have appeared on the quantitative radar this month, largely due to the currency impact of the pound. As these funds did not appear on the radar for the USD fund class, there are currently no funds on our qualitative radar. Just to conclude, as you can see from the chart, The funds have performed exceptionally well on a year-to-date basis with strong returns. The Global Preserver, Moderate, Flexible, and Creator are well into their respective risk categories, performing well. Thank you for attending this performance update. Please take note of the following disclaimer, and should you have any questions, please feel free to contact us.